Tesla is now going to be going to shareholders, asking them to vote again on Elon Musk's multi-billion-dollar pay package that they had already granted back in 2018. But a Delaware court had voided that package about 3 months ago. Join us right now to talk about this on the Squawk Newsline, former SEC Chairman Jay Clayton, also a CNBC contributor. The appeal is going to happen in parallel. They're going to continue that, but it appears that such a vote, if in fact it was to vote in favor of it, Jay, would make any type of appeal moot. What do you make of this idea that they're basically going to attach the decision to the proxy and say, hey, we've just, if the judge didn't think we disclosed everything before, we've disclosed everything now?
Well, I think you've captured it exactly right, Andrew. Here we go back out to shareholders, and we say, you have the facts, and now you have the benefit of all this hindsight. And if you vote in favor of the same package again, to me, and I'm speaking just very 30,000-foot level, it does obviate the need for the appeal. And look, appeal process, court process is fairly messy. And if you go to direct to shareholders and they have all the information, that seems to be a much more efficient way to deal with this. If in fact shareholders want to continue with this pay package. And what I'll note is, this is all part of, I would imagine, retention of Mr. Musk going forward as well.
And that's the big leverage point in this, which is to say, I think a shareholder has to worry or would have to think about whether they should be worried that he's going to, focus his attention elsewhere. Having said that, as the judge said, he already owns a huge portion of Tesla. Is he incentivized to keep going, if you will?
Well, shareholders made the judgment. Look, whether shareholders knew or did not know of the conflicts and what the judge cited was lack of process and the like at the time, when shareholders voted on this in 2018, they certainly understood the economics.
Yep.
It was widely reported. You widely reported. I think it was a 25, 30 to 1 shot that this would pay off. The expected value at the time was $2 billion. The shareholders, the sophisticated shareholders, they knew what they were voting.
But Jay, so that's the interesting part about this, which is to say, you're right. In 2018, everyone thought this was a completely shoot for the moon, as I said at the time, a skin in the game program. But and that was thought, but the context was different. Everybody was thinking about it prospectively, and they thought, you know what, if magically this actually were to somehow come to be, God bless, you'd be very happy to pay it. However, as you know, there are lots of people that when they get in a position and they can now look back and say, do I need to pay all $50 billion? If I could cut that by $10 billion or $20 billion, would I? And I think that's going to be the question today. And, they did say, Tesla, that there are 4 of the largest shareholders in the company that want this vote and want to vote in favor of it. But I'm curious how you think shareholders should think about this, even the ones that voted in favor of it the first time.
Well, I do believe, and Andrew, I'm not an expert on the terms of this pay package. I do believe that there's a retention element.
Yes.
If the shares are awarded as planned in 2018.
For 5 years. I mean, that was one of the reasons that I thought the program was actually so aligned with shareholders. He has not been granted any of the shares yet. And even if he were to get them today, he would still have to hold them for another 5 years. So he's with the shareholders for the next 5-year ride.
So I think you're right to think about this in both ways. What was originally granted? If you're a shareholder, what are the likelihood that it's going to be reversed on appeal and go back to the same way? And then what's the likelihood that you're going to have to replace it if it's not reversed on appeal with something similar? A rational shareholder may say, hey, let's just vote for this and get on with it.
From an SEC perspective, Jay, are there no issues to be looked into? I mean, can a company put up for vote a pay package for work that was done in the past, which is kind of unusual? I mean, how do you think about, if you were still at the SEC, how would you think about this?
Well, look, the SEC is a disclosure-based organization, and the real question here is the disclosure sufficient for people to make an informed voting decision? In this one, of course, the SEC is going to look at it and think about it, but this may be the most disclosed and examined pay package in the history of pay packages.
Final thought, Jay, which is there was obviously a plaintiff's lawyer that brought this case, and we were talking about the possibility that the plaintiff's lawyer could actually become part of a proxy campaign against the approval of this. What would happen to the appeal if this, in fact, were to be voted and approved? Do you think that Tesla says they're going to continue with the appeal? Part of that would be because they'd have to probably pay the legal fees for the plaintiff's lawyer, right?
Look, let's separate that from the shareholder voting process. It's America. Wonderful thing about America is we're going to hear all sorts of opinions on whether people should vote yes or no with the disclosure. In terms of how the court plays out and whether the plaintiffs at the end of the day added value for the
right.
Tesla shareholders, that will be that question. Did this process add value, and should they be compensated for it?
We got to run. Is it maybe we're playing it down? I don't know. The Texas piece of this, they're going to move to Texas. That had been sort of telegraphed. Do you think that other companies are going to follow suit?
Andrew, corporate governance has been evolving for 50 years between the states and between the federal government and the like. And there has been competition for shareholders and corporations as to where they're going to incorporate. I do think that Texas, Nevada, others are challenging Delaware. And look, our federal system, it's appropriate to have competition. And I don't think this is necessarily a race to the bottom.
The shares down more than 35% year to date, and the company now set to report earnings next week. Analysts divided on where the stock's heading from here, and so is the investment committee, it turns out. Bryn long, Weiss short. Bryn, make your case. Why should we still believe in this stock story?
Well, the stock right now doesn't look good. So let's just separate the two, the stock from the company. Make no mistake, the chart looks terrible. Don't forget that in January of 2023, I bought it around 120. This stock got to, I think, $100 during the early part of 1 day of trading, and that's with earnings estimates of $5 for full year 23. So we're not even going to sniff that this year. So this stock could go lower. Let me make that clear. It looks broken right now. Why I would not what I wouldn't discount is Elon, is I think he's one of the most, prolific innovators and engineers of our time. With SpaceX, literally, I think NASA would be defunded with what he's done with energy storage and EVs, and then at Neuralink. And so I do think, though, he is going to have right now, between this earnings report, which will be bad, and the shareholder package, I think it's very murky right now, because make no mistake, part of this valuation is based on sentiment and also valuations, margins, and earnings expanding. So I see absolutely why Steve is short. I don't think he's going to be short long term. I think it's probably a trade. But I think longer time, we will get some clarity. And this will be, over the next few months, a potentially good opportunity to add or buy to the position.
My question for Bryn, and I'm not trying to be difficult with this, is that as a fiduciary of her investors' capital, how could she invest in a company where there is no governance, there is no independent voice on the board, where they've gone out and made an acquisition like Solar City, right, to stop it from failing because it was his brother's company, and because the federal government told SpaceX, you've got to stop buying Solar City bonds with the money we're giving you for R&D, where he's tried to buy, use Tesla to buy material for his house, the windows, where he wants a $55 billion pay package, and where we saw Jack Dorsey with 2 companies. We've got Elon Musk with multiple companies that all require his time. Plus, there's the allegations, and we saw it on Joe Rogan's broadcast, of drug use. So how's a fiduciary own this company with anti-shareholder governance repeatedly, time after time after time? Isn't it worth just passing on this and going to something you don't have to explain owning?
Yeah, well, I own this personally, first of all. This is a personal position. So I think, we love to own broad-based ETFs for the majority of our client base. So this is not a fiduciary decision. This is my decision. And so I think that, what you're pointing out, these things, I think you just don't like Elon. And so I think that if you separate yourself and say, look at this company, well, I think that's the truth, right?
I'm not showing you sentiments. Everything I said is a fact, Bryn. It's a fact.
I know, but he's a grown man, and the Joe Rogan thing is just strange, and that was years ago.
It's not just Joe Rogan.
And so I think that if you just look at the company, if you look at the company, and when you still look at the two companies where the best engineers want to work, is our SpaceX and Tesla. Because this is not an Elon show as well, although it feels that way. He has to be able to retain top talent. And I think as it relates to Tesla specifically, being pragmatic about the company, as I said, the chart looks terrible. And they are in a very murky situation right now because it feels like, are you going to be a car company that's balancing higher revenues, higher earnings and margins, and then also innovating at the same time with full self-driving, more energy and robotaxi? Or are you going to do a full pivot to robotaxi? I think if they come out and do that, that's a revaluation of the name on the downside, because that is probably 5 to 10 years out. So,
and by the way,
I think that, yeah.
By the way, Weiss, sorry, Bryn, if this is principally a governance-related story,
that's one aspect of it.
Sounds like it's a major one. However, you could, right? It's major.
Even put that aside, the fundamentals deteriorating. We've hit limit in terms of the EV adoption. They've got the oldest EV lineup in the industry globally. They've got 20% of their revenues coming from China. We've seen what China has done. Okay, we've seen Apple move their supply chain to India. And they've got better relationships and longer-standing relationships with the Chinese government. We've seen China. China is supporting their domestic producers that, by the way, make newer, more richer in terms of the accessories, in terms of basically even the range, so of their cars than Tesla. That's number two. Yeah. Number three, we've seen Elon just tweet out, oh, no more prices, we're raising prices. He lied. They're cutting prices. We would say big robo-taxi announcement. We've secured funding for the take private. The guy is a pathological liar to keep his stock price up. So forgetting about that, the fundamentals deteriorating. You've got lots full of EVs that are selling at major discounts from the major auto players that couldn't sell them. So the fundamentals are horrendous.
Bryn?
Yeah. So I think that in China,
one more thing.
No, let Bryn go.
One more thing. It's like one more like buzz line. It's like, once again, you just don't like Elon, by the way. And so it's like when you look at
genius. I've said that repeatedly.
When you look at the EV market, there actually continue to be, with BYD, the top-selling brand in China. And so while we look at America, which is about 9% of the EV space, China, which Tesla was it's like the only manufacturing company that was able to build in China autonomously without having influence from the Chinese government. He has a very strong relationship. I believe they're about to announce they're going to be building their next gigafactory in India, a huge untapped market. And so I think that when you look at this company in the U.S., if this was a U.S. EV story, I would not own this name. I don't think Americans want to drive EVs. I think Americans don't want to drive EVs as their only car. But in China, it's a very different story.
Well, let me just say something.
Hold on, let me work this in, and you can say what you want. Then we're going to be done. Adam Jonas today at Morgan Stanley. Why do we remain overweight Tesla shares? And look, he's been, skeptical along the way about, the repeated price cuts and all the other stuff. We believe Tesla has significant attributes to be valued as an AI beneficiary, but the company must first see stabilization in the negative earnings revisions within the auto business.
Yep. Right, he's not saying they have. Yep. But Bryn's entirely wrong about their ability to retain talent. If you take a look at Tesla, and you take a look at, we just had 2 critical people leave Tesla this week. Their turnover in their executive ranks and their engineering ranks is legendary, is unprecedented. So I don't know where she gets that from, but look at the facts. And I know it's maybe because I just don't like Elon that all these people are leaving, but I really had nothing to do with it.
No, I totally, I mean, once again,
the stock is
definitely
up. So you feel the stock is up 750% over the last 5 years.
Exactly. Yeah. And I haven't been short over 5 years. I'm short now because it's all coming home to roost.
I understand, but there are periods of time over the last 5 years where notable people have been short, and it hasn't mattered because their shorts have been proven to have not worked well.
Again, I haven't been short, number one. Number two,
I understand.
How many other EV manufacturers have we had over the last 10 years?
Bryn?
I don't even know what that means.
How many price cuts have we had with Tesla models over the last 5 years?
How many cuts? Steve, wisdom is chasing you if you would just stop. Okay? Like, seriously. Like,
what the hell is she saying? I don't even get it.
Steve, we're going to take a break. We're going to take a break.
Just admit you're wrong and the stock is going lower. And I'll buy more lower. That's what she should be saying. Facts are facts.
There's no fact that the stock is doing anything.
There are facts with everything I said about the governance, about the price cuts, about his tweets that have all been wrong, about the competitive landscape, about the appetite for EVs. Those are all facts.
Fewer days away now until the Bitcoin halving, which reduces the supply of new Bitcoins. Currently, Bitcoin price is sitting at $62,710. Joining us now, Anthony Pompliano, Pomp Investments founder and partner. I want to talk about the halving. I want to talk about the run-up in the price, and also the flip of that, which we saw last weekend. You were kind enough to tweet back at me over the weekend. We were trying to understand some of the movements. Explain to the audience what you think has happened even in the past week, both in terms of the run-up and maybe this move lower.
Yeah. Well, let's put everything in context, right? Talking about Bitcoin is crashing to $64,000 was a dream just a few years ago. So we're up significantly. Since the last halving to today, about 4 years, we're up 800%. So it's been incredible performance. This year to date, it's about 40%. Compare that to gold. Gold's up 7%, year to date. And in the last 5 years, it's only up about 11%. Now, the reason why I bring that up, what I think is really interesting, is you actually have lost purchasing power if you've held gold over the last 5 years. Inflation has outpaced gold's performance. So the whole narrative of gold protects your purchasing power is now been debunked, right? For the last 5 years, that's not true. Bitcoin has. So when we start talking about this price run-up, that 40% increase to start the year, all of a sudden, why is the price going up? ETFs are a huge piece of it. Also, I think people leading into the halving, that's a big piece of it. But the government has decided we are going to debase the currency, right? And I think that now the world has understood the United States has a debt problem and we're going to debase the currency. So there's some of that going on as well. Now, over the weekend, the price sells off. And I think there's really three things that drove that price sell off. The first is that whenever there's a moment of fear, right, everyone panics. And what do? They still buy dollars. And so some people are selling because of that. The second thing is on the weekend, even though the Bitcoin market is open, the bank system is not open. And so you can't get net new dollars into your crypto account to buy Bitcoin. So the only thing you really can do is if you're holding Bitcoin, you can sell it. But most of the people holding Bitcoin are fully allocated. So they don't have dollars to go buy more Bitcoin. There's a very interesting dynamic where even though you want to buy more Bitcoin, you're closed out of the system as well because the banking system won't let you wire in.
You're saying people would have bought Bitcoin on Middle East tensions if the banking system were open?
The joke is that the real Bitcoiners want the price to go down so they can buy more of it.
So what have we seen since, since then in terms of the price of, we didn't go up a lot.
We didn't go up a lot, but we're basically flat since
so no one is buying
since Monday.
On the heels of Middle East tensions.
Well, I think that the other thing that's happening is that now Bitcoin is being pulled into the legacy system. And so now it's very hard to kind of prove this, but high-frequency traders and kind of more algorithmic trading, when all of the news hit Twitter and kind of the social sentiment changed very quickly, you saw a massive amount of tweets about Iran and Israel and rockets and drones, et cetera. There's a very quick sell-off. I find it hard to believe that humans were able to read Twitter, immediately go to their computer and start hitting the sell button. And so there's got to be some algorithmic trading that's going on there as well, where people are trading headlines. Okay, but it's unclear how to measure that.
Let's just understand this, because part of it is, so the folks who are selling likely are selling actual Bitcoin, not the ETFs, because this was happening
closed
over the weekend, right?
Correct.
And so, then the question seems like the natural follow-up is, why were they not back in the market, either via ETFs or something else? Put the algos aside since then, and on the back of what I imagine is, you think, a bullish sign on the halving piece of this, which is about to happen.
I think that markets are forward-looking, and part of my analysis is just that, we went up 40% because people are already pricing some of this stuff in. If we go and we look, we had Russia invading Ukraine, we have Hamas, Israel, now we have Iran, Israel. At some point, there's a less severe reaction to each one of these kind of geopolitical events, because I think people are starting to say, there are problems in the Middle East. Right. And so, again, that doesn't talk down the severity of what actually happened. But I think that the financial assets themselves are becoming less sensitive to those movements. And then in terms of buying more Bitcoin, I do think that there's this very interesting dynamic of everybody that I know in the hardcore Bitcoin community. They've bought as much Bitcoin as they possibly can. The net new dollars that are going to come into this industry are going to come from Wall Street. Right. And so what is Wall Street doing? Wall Street's not rushing to go buy Bitcoin today. And I think that there's a lot of folks on Wall Street who don't yet even understand the halving. And so what's going to really play out here is over the next 12 to 18 months, we'll see that impact.
And they're not buying because, the only reason you wouldn't buy today, besides that you may not have the opportunity, which is to say there's an argument that, advisors, a lot of firms don't have it on offer yet. But There's also the view, I think, by some, that the price is still going to come down. So how do you see, I mean, what do you see as the window for where the price sits right now?
Yeah. So if we look at price movements themselves, Bitcoin's down about 8%, 9%. In 2017 bull market, there was 13 drawdowns of 12% or more. There was 13 drawdowns of 10% or more in the 2020 drawdown from Galaxy Research. And so when you see that big of drawdowns, 8% is actually a pretty small drawdown compared to most times in bull markets. And so my expectation here is that Wall Street is probably trying to time the market a little bit, understand, what's the price level, so looking at technicals, et cetera. But over time, what we have found is that in these drawdowns, they're getting less and less severe. So the asset itself is becoming less volatile, which means that the upside gets more limited, but also the downside is muted.
We'll take Cathie Wood's prediction out of it. But for the next 12 months, for you, potential high, upside, potential downside.
I think downside is pretty muted at this point. Like, it's impossible to tell. There's always the external event that could occur. But I would say I don't see it going below like 50,000 at any point. I think we've kind of crossed over that Rubicon. In terms of upside, I think we get over 100,000 in the next 12, 18 months. Maybe we could get to 150 to 200, somewhere in that range. But like we go up from here. I just don't think people should expect the explosive, 1,000% move from here through the rest of the bull market.
Fear is back on Wall Street as volatility bets tied to the VIX hit a 6-year high earlier this week. And our next guest writes in the Wall Street Journal that traders are positioning for a prolonged stretch of volatility. Gunjan Banerji is the lead writer for the Wall Street Journal's live markets coverage, as well as a CNBC contributor. Gunjan, great to have you with us.
Thanks, Melissa.
6-year high levels seem like a big deal, but in particular, if you think about what was going on 6 years ago, because February 2018 was a huge volatility event.
Crazy. I mean, that was Volmageddon, right? We saw a huge explosion in volatility at the time. S&P 500 lost around 10%, a very short time frame. What traders said was alarming about this time around was that we're only 3 to 4% off the highs in the S&P 500, and yet we're seeing this stampede into VIX bets, into volatility trades, and wagers that this recent turbulence that we've seen over the past 2 weeks will continue. And this is really the first sign of fear that we're seeing in the market after really going in a straight line up for months now.
I mean, the idea that we had actually gone on Friday, what did we get to, like 20 or 19? I mean, really, historically, that's not very high. But in a world where the VIX had been regularly at 15 or 16 or 14 or even lower, that seems like a huge spike. What are traders saying in terms of how high volatility can get and eventually how that will impact the markets? Because volatility is just a bet that it's up and down, right? It's not necessarily that stocks will go down.
That's true, Melissa. But what's remarkable is that the past few weeks or months, we'd actually seen bets on upside volatility, bets that things would get volatile, but NVIDIA shares would keep skyrocketing, or the S&P 500 would get more volatile in terms of big jumps up. People were afraid of missing out on those rallies to the upside. And now we're seeing downside hedging. We're seeing actual hedging, the types of trades that would profit if the stock market did fall. Think of these as insurance-like contracts. The demand for stock insurance increased significantly over the past 2 weeks. And this is a remarkable shift from, the roses and sunshine that we saw the prior months. And I think a lot of it comes down to inflation, geopolitics, and of course, the path of treasury yields, which I think are finally spooking the market after, the stock market being pretty resilient in the face of rising yields recently.
So when you're talking about bets on volatility in terms of, hedging, are you also seeing commensurate trades on the option side for SPY and for NASDAQ 100 in terms of hedging?
You know what's interesting? A lot of traders have been telling me this is concentrated in the VIX complex.
Oh.
And that's interesting because, as you pointed out, we have seen the VIX rise to some of the highest levels since October, November. And while there has been a pickup on the S&P 500 side, that's what the higher VIX is reflecting. People are placing call options bets tied to the VIX itself. And that's really a true volatility bet. That's a bet that things could kind of get haywire. And we're seeing that in the futures market as well, where pricing indicates that people are expecting more volatility over the next month or two than, say, in the next 3 months. So there is this near-term fear that this whole complex is reflecting right now.
What do you think are the fundamental reasons for it being a 2 to 3 month bet? What events on the horizon? Is it just the uncertainty about interest rates at this point, and probably increased uncertainty now that Fed Chair Powell said what he said yesterday in terms of keeping rates where they are for longer?
Right. So, Melissa, what I did hear was that a lot of this activity started picking up Friday, heading into the weekend. And that was a lot of the
Yes,
it was the geopolitical fears where people were saying, We don't know what's going to happen here. And that led to that rush into VIX options bets. It continued this week, and it's been incredibly elevated, especially when you think about the calm that we saw previously.
Do you think traders are thinking in their head that we will see that 10% decline, the same that we saw during Volmageddon?
Look, I think we're 3 to 4% off now. And what traders have been telling me was it's almost like people woke up and realized, hey, the stock market doesn't go down. It can go down. It turns out we can have a little bit of volatility. And I think people forgot that. And I think we could see more of that today. We have a treasury auction at 1 p.m. These have become like the hottest, things to watch on Wall Street. They used to be really sleepy, but they're causing a lot of volatility. We saw that last week after the inflation data, where the 10-year recorded the biggest one-day jump since 2022 after kind of an ugly auction, some ugly inflation data, and I think we need to stay tuned for that today.
Yeah, a down 10% actually lines up on the technical side of things for the S&P 500, so that's interesting that they're targeting that or thinking about that in terms of the time frame. And on the technical side, that's where we see the S&P getting down to the bottom channel.
What the backup in yields and in expectations for rate cuts mean for this market, this record-setting run in stocks. Let's ask Josh Brown. He's the co-founder and CEO of Ritholtz Wealth Management. With me here at Post 9. It's good to see you. Been asking all day, really for the last several days, whether the playbook for investors needs to change as expectations on rate cuts are firmly reset. How would you address that for the calls that you might be getting at Ritholtz?
So, look, I think the big thing that's happening right now is we're washing out some of the excess enthusiasm that we came coasting into the month of April. If you remember what we were talking about late February and throughout the month of March is the broadening of the rally, and truly it was broadening. It even eventually found its way into small caps, which is a group that honestly can't get arrested. Even those stocks were going up. And now we get a little bit of a washout of some of that enthusiasm, but a lot of big charts are still intact. And what's really changed here on the internals is the percentage of stocks that are in their own individual bull markets. 39% of S&P 500 components are currently above their short-term moving average, 50-day moving average, okay? That number was 90% coming in to April. So it's definitely a correction-ish thing happening for small and mid cap. Large cap, there's not a lot of damage. Apple's actually one of the worst names in a 15% drawdown. Most large caps are still intact. They don't look as bad as Apple. And I think if you were to pull semiconductors out of the equation today, we might even be green.
Are we moving back to a stay big and don't go broad market? So over the last month, or at least month to date, to your point, Russell's down 7.5%. But if you look at other things that are impacted by a backup in rates, real estate's down 9.5%,
Yep.
Dividend Aristocrats down 5%, Staples down 4%, utilities down 3.5%. So do I need to rethink the whole thing right now?
No, because those drawdowns that you're quoting to me are off of new highs in many cases, like not necessarily real estate, but the dividend stocks, for example. You've had new highs in these segments, and these are stocks that have gone up anywhere from 20 to 50% since the bottom in October. So I don't think that a 5 or a 7% pullback is disastrous, and in fact, you would probably expect it to be part of a healthy bull market. So I don't think we're in this moment where we want to rethink. I think what we do want to do right now is remember, semis are 9% of the S&P 500, 20% of the NASDAQ 100. And let's look at what ASML actually said. It's not great, but it's highly company specific. They beat on earnings, but they missed on sales. Q1 sales were already forecast to drop year over year, but this was a much worse outlook on booking. And booking is how these companies make their numbers next quarter and the quarter after, et cetera. Q1 bookings, 3.6 billion euros. The forecast was 5.4. It's an ASML story. Now, Intel gets hit, Nvidia gets hit, and again, remember, semis are a huge part of the S&P. They were never 9% throughout my entire career, and so you're going to have this outsized effect at an index level. But when I look at my screen, I have green. I have tickers that are higher. Defensive stocks are doing their jobs. They're acting defensively. Utilities are up a lot right now. I have pharma names that are up. So I don't think it's this across-the-board rethink. I still think we have enough positive breadth away from large cap that the entirety of the story remains intact. I just think it gets a little bit harder.
Let me just zero in for another moment on dividends because they're so near and dear to a large swath of our viewing audience, I think. And, you know, we were coming off of a tough year for dividend stocks.
Yeah.
And the narrative coming in was, okay, rates are coming down, so dividends are going to be good. And they're going to have a good comeback.
Yeah.
And now if rates are going to back up, maybe not so much. Maybe those who really spend the time looking for the dividend stocks to get that income are going to have to rethink at least that part of the market.
So, as you know, Jenny Harrington and
I'm thinking of Jenny.
We have a, I don't know, 7-year blood feud running. I disagree with the premise of let's identify a specific dividend yield and then hope we like the stock that's attached to it. I just don't think the majority of investors are targeting in on a yield and then working backwards. I happen to think the better companies pay dividends, not usually the highest dividends, but the dividends that are most consistently growing from one year to the next. And oftentimes when we're talking about dividends, we're talking about quality, number one, and we're talking about companies that are also, in addition to paying out a dividend yield, doing a decent-sized buyback. That story, I also think, remains intact. We should see $1.2 trillion worth of buyback activity worldwide. It's actually growing overseas faster than the dividend activity is recovering here. You would be understanding, looking at companies in 23 and 22, slowing down with the buybacks and slowing down with the dividend growth. There was a lot of uncertainty, and people just weren't sure how they would fare in a higher interest rate environment. Now we're in one. We've been in one for a while. We kind of know we'll be in one for a while to come, and companies are still looking opportunistically how they can return cash in the most shareholder-friendly fashion. I don't think that theme's going to be extinguished this year.